Hello, we've all heard the saying about investing. It's about time in the market, not timing the market. Most of the time, that is solid advice. But there is a specific statistic that gets thrown around by financial advisors that is downright misleading.
You've probably heard it before. It says, if you missed just the 10 best days in the stock market over the last 30 years, your returns would be cut in half.
It sounds terrifying. Hearing this is like FOMO, fear of missing out, but on steroids. It suggests that if you try to avoid a crash and happen to be sitting on the sidelines for just 2 weeks worth of trading days, you've essentially ruined your retirement.
Today, I want to pull back the curtain on that statistic. We're going to look at the math, which is correct, but then we're going to look at the context, which is where the story starts to fall apart.
Just a note before we start. This video is for educational purposes only and is not financial advice. All investing involves risk, so always consult a professional before making investment decisions, as we cannot take liability for any financial losses. Let's start with the claim itself. The general statement is that over a 30-year period, the market might return around 10% annually on average. However, if you miss the 10 best performing days on Wall Street during that same period, your growth would drop to around 4%. The implication is clear: don't pick and choose when to be in or out. If you try to time the market to avoid a crash, you risk missing those massive up days, and you will lose out in the long run. It's a powerful argument for toughing out the bad years. But here's the catch: context is everything. We decided to look at the actual dates of those best days. If the market is a steady climb, you'd expect these best days to happen during periods of economic boom, right? Maybe during a tech breakthrough or a period of world peace. The opposite is true. The biggest gains almost always happen during the biggest crashes. Look at this list of the top 10 gains over the last few decades. Look at those dates. 3 were during the 2008 subprime crash. 4 were during the height of the COVID-19 panic in 2020. These weren't days of steady growth. They were days of extreme volatility where policymakers were trying to throw quick fixes at a falling market to keep it from collapsing entirely.
The reason the best 10 days argument is misleading is that it ignores the worst 10 days. If you were out of the market during the best days, the odds are very high that you were also out of the market during the worst days, because they happen at almost the same time. Let's look at the dates of the 10 biggest losses. Notice the overlap? In 2008, you have massive losses on October 9th and 15th, but massive gains on October 13th and 28th. In 2020, you have a massive loss on March 12th and 16th, followed by massive gains on March 13th, 17th, 24th, and 26th.
The best days are almost always nestled inside the worst months. If you weren't in the market to get that 11% gain on October 13th, 2008, you also weren't in the market to suffer the 9% loss 2 days later. You didn't benefit from the surge, but you also didn't lose your shirt in the crash. When the market is healthy and quiet, it grows steadily. Most of the last 30 years were characterized by this kind of quiet, reliable growth. The top 10 days are outliers. They are the symptoms of a sick market, not a thriving one. Using these outliers to suggest that market timing is inherently destructive is a bit dishonest. While there are many valid reasons not to try and time the market, like the difficulty of predicting the future or the cost of taxes and fees, missing the top 10 days is not the deal breaker it's made out to be.
So, what does this mean for you as an investor? This video is not meant as market advice, but general common sense suggests that you examine scare tactics with detail. Look at the context of sensationalist claims and statistics. Focus on the long term but remain informed. It's the good and quiet times that provide the bulk of your actual growth. And recognize volatility. Understand that big swings in either direction are usually two sides of the same coin.
Thank you for listening. As usual, I would now like Pete, our peer reviewer, to present some counter-arguments to the earlier points raised.
Hi, thanks for that, John. Here are a few counter-arguments to give a balanced view. Firstly, the common comment I have: we live in very different times that we did 5 or 10 years ago with trading apps and AI. Who knows if your statistics will repeat themselves? The past doesn't always predict the future. Markets might well behave differently than before. Second, you mentioned the 10 biggest jumps and drops, but what about the next 10, 20, or 30? When you add them up, they could matter even more. You're right, context is key, and your video only shows part of the story.
Thanks, Pete. And thank you for listening. We've covered a lot of ground today, but this is only one of 30 critical topics every serious investor should master. If you're looking to fast-track your learning and avoid the trial and error of the markets, I highly recommend picking up our comprehensive guide on Amazon. It consolidates the best insights from our first 30 videos into one high-level manual, complete with exclusive explanations you won't find on this channel. It's designed to be the definitive resource for your library. The link is in the description. I'll see you in the next video.